After several years of extraordinary shocks, the Irish economy has moved into a more familiar rhythm. That might seem surprising given the global uncertainty, but the evidence shows a period of relative stability. Growth is steady, inflation has eased back towards central bank targets, and while the labour market has softened, it remains resilient by historical standards. The global backdrop, however, is far less encouraging. The IMF expects world growth to slow over the next 2 years. Advanced economies are anchored closer to 1.5% in terms of growth, and productivity is weakening. Investment is hesitant and policy uncertainty remains high. Protectionism, industrial strategies and geopolitical tensions continue to shape that wider outlook. These pressures are reaching Ireland, but the impact so far has been moderate. The central bank's latest bulletin highlights the new US-EU tariff regime is less severe than many feared, but still a meaningful shift. The bank estimates Ireland's national income could be about 1% lower in the long run as a result of the tariff changes. Not disastrous, but clearly a headwind. The standout story remains domestic demand. Modified domestic demand grew by almost 4% in the first half of the year. Construction, retail, transport and professional services all contributed to that growth. Housing output and energy projects continue to provide support, helping to offset more uneven multinational activity. And the consumer remains central. Real household incomes rose last year, fewer households reported liquidity pressures, and saving levels are still elevated. So consumption grew by 3% in the first half of the year. People aren't spending freely, but they are spending consistently. And there's a little bit of a dichotomy in the story because sentiment is telling a different story. The latest index fell to a 3-month low from the Irish League of Credit Unions. 3/4 of households expect living costs to rise next year, according to that survey, and only 1/3 expect incomes to improve. Groceries and energy remain the main pressure points. This pattern of soft confidence but steady spending has become a defining feature of the post-pandemic period. And the labour market helps explain it. Vacancies have eased and hiring intentions are more cautious, but employment remains high, wage growth is firm, and inward migration continues to support labour supply. And we see some of those same dynamics in Dublin, often even more clearly. As a service-led economy, the city reacts quickly to changes in income and jobs. Employment in Dublin rose by nearly 1% in the third quarter and almost 2% over the year. Construction led the way with moderate gains across the public and private sectors. Hiring is cooling though. Vacancies have fallen to their weakest level since 2021. Turning to housing, so often the main story in an economic development context, it remains the city's biggest pressure point. Prices hit new highs in the third quarter, up just over 5% on the year, and demand is strong. Supply is moving in the wrong directions and completions are falling, and commencements fell sharply too, down more than 80% year on year. Financing conditions, rising costs and regulatory hurdles are still weighing heavily on delivery. So heading into 2026, the picture is one of domestic stability set against a much more fragile global environment, and that's leading to an easing in momentum with risks remaining. But household spending is holding up, employment levels remain high, and Dublin's economy retains a solid core.